Why smart traders keep losing and how to beat the market's mind games forever. Trading Psychology Mastery. You are smart. You have degrees, pattern recognition skills, and a head for logic. Yet trading keeps slipping through your fingers. You plan, you analyze, you press buy, and then the market behaves like a stranger that does not care how intelligent you are. If that sounds uncomfortably familiar, breathe. What follows is not a promise of profits. It is education only. It is a structure for taking your ego off the field so your process can finally play the right game. In this channel, we put mind over markets. We practice simple behaviors that survive stress, and we let the scoreboard reflect discipline rather than drama. If you have ever felt the weight in your chest when a red candle eats your plan, this is your invitation to trade a different way. The paradox is simple. Markets reward humility and punish pride. Smart people are trained to win arguments, to force solutions, and to be right. Markets are not a classroom and not a debate. They are crowds of human emotion. Greed, fear, hope, and regret run on their own schedule. If you keep bringing more logic to an emotional battlefield, you will lose to someone with less education and stronger obedience to rules. Many traders learn this the hard way. They average down to prove a point. They hold losers because admitting a mistake would hurt their identity. They add to a position because the chart must be wrong and they must be right. The market does not punish intelligence. It punishes ego. The moment you accept that your edge is not cleverness but consistency, you begin to play a new game where your job is to follow standards that work across seasons. Here is the heart of the method. You need a rules-based system that is cold, tested, and resistant to emotion. William O'Neill studied a century of the biggest stock market winners and distilled 7 repeating traits into a blueprint called CanSlim. Use it as a screen and as a checklist. The letter C points to current quarterly earnings growth that is strong, often 25 to 50% or more, and it should be supported by healthy sales growth. The letter A points to annual growth that accelerates over several years with high returns on equity. The letter N stands for something new, such as a new product, a new management team, a new industry cycle, or a new price high that signals demand. The letter S captures supply and demand, meaning a relatively low float and clear signs of heavy accumulation by buyers. The letter L says you want leaders, not laggards, names with superior relative strength versus their group and the broad market. The letter I stands for institutional sponsorship, which means quality funds and pension managers are accumulating shares over time. The letter M is market direction. You align yourself with the trend of the major indexes because the tide moves most boats. This framework does not guarantee outcomes. It filters noise and focuses your attention on the conditions that tend to precede large advances. Now we have to talk about execution, because intelligence without discipline is financial theater. The market pays traders who obey rules, who let price be the judge, and who cut losses without bargaining. A core rule is the stop loss around 7 to 8% below your buy point. Place it and respect it. If the line is touched, you sell without debate, without waiting for news, and without consulting your feelings. The goal is not to be right. The goal is to be consistent. When you cut a small loss, you are buying information cheaply. You learn that your thesis was not confirmed, and you free capital and attention for the next setup. When you ignore a stop, you are paying tuition to your ego. You also teach your future self that rules are optional. The cost of that lesson compounds in the wrong direction. Discipline is cheaper than regret. Identity is the foundation. Every trade mirrors the person who placed it. If your identity is the always right thinker, then your losses will drag on because you would rather defend your idea than defend your account. You need an identity upgrade. Think like a performer who executes a score on stage. The best musicians are not improvising the entire symphony while the audience waits. They have rehearsed, they trust the sheet music, and they hit their marks even when nerves spike. Adopt the identity of a performer of rules. Before the open, you rehearse the scenes you may face. During the session, you execute the score you wrote while calm. After the close, you review how well you followed your own music. You can be brilliant in analysis and still fail at performance. The solution is not more intelligence. The solution is a new identity that values execution more than opinions. Habits make this identity durable. Willpower fades under stress. Process survives. Put pre-commitment into your routine. That means you write your if-then rules before you face the opening bell. If a stock breaks out of a valid base on heavy volume and the general market is in an uptrend, then buy a defined position. If the name stalls or reverses on increasing volume, then respect the stop. If the trade moved in your favor by 20 to 25% in a normal market, then take profits on at least part of the position and trail the rest with clear rules. Build a morning checklist that includes market direction, leading sectors, watch list names near proper entries, and exact risk lines. Build an end-of-day checklist that scores process and updates your journal. The point is to make the right action the default action, so that you do not have to negotiate with fear in the heat of battle. Losses are not personal, they are data. Treat them like the cost of testing a hypothesis. The 7 to 8% stop is a psychological shield. It turns a potential spiral of hope and denial into a clean decision that frees your attention for the next setup. When you follow your stop, you win twice. You avoid a large drawdown, and you strengthen your identity as someone who executes. This reframing keeps regret from writing your script. A small planned loss is a sign of professionalism. A large unplanned loss is a sign that emotion took the wheel. The market will always hand you losing trades. Your job is to keep them small and to use them to sharpen your edge. Most traders obsess over buying and almost ignore selling. That is why many winning trades turn into break-even or worse. Selling must be planned before you press buy. Decide your exit conditions in advance and write them down. For standard winners, a quick harvest of around 20 to 25% can bank gains before the crowd arrives. For potential market leaders, you can trail with a set of price and volume rules that keep you in while the trend is healthy and get you out when distribution appears. You might sell into strength when a stock becomes extended above a moving average and then buy back on a tight consolidation if the market remains constructive. The exact mechanics matter less than the fact that your rules are written, tested, and executed without negotiation. What makes a true market leader? The same traits appear again and again before the big run. Explosive earnings growth that surprises. Something new that captures demand. Strong relative strength that proves the stock is outpacing the market. Breakouts on heavy volume that confirm professional buying. Chart behavior that looks tight and controlled rather than sloppy and wide. Leaders often look expensive to the untrained eye because they are already near highs. That is why most people miss them. They are busy shopping for low price tags. The market often rewards quality and punishes cheap without a catalyst. When your screen shows earnings power, new catalysts, real sponsorship, and leadership within a strong group, you have ingredients that justify buying higher quality even when the price looks high. Reading the mood of the overall market is not optional. Even the biggest leader can sink if the tide turns. Watch the major indexes such as the Nasdaq and the S&P 500. Pay attention to volume on up days and on down days. After a correction, look for a follow-through day when a major index rises with power on higher volume than the prior day. That signal does not guarantee a new uptrend, but it tells you that risk may be shifting in your favor. Never fight the trend. Align your exposure with the market climate. When distribution days cluster on the indexes and leading stocks crack support, you lower exposure or move to cash. When leadership broadens and breakouts work, you can step forward with measured size. Market context is the weather. You choose clothing to match it. Position sizing is how you survive long enough to succeed. The rule is simple. Never let one trade destroy you. Choose a maximum % of your total account that you are willing to risk on any single idea. Then size the position so that if your stop at 7 to 8% is hit, your account level loss stays at or below that risk %. For example, if you are willing to risk 1% of your account on a trade and your stop is 8% from your entry, your position size should be roughly 1/12 of your account value. This is not about precision to the decimal. It is about honesty with risk. Concentrate only when the market is healthy and your setups are textbook. In weak climates, shrink your positions and your expectations. The amateur asks, "How much can I make?" The professional asks, "How much can I lose and still sleep?" Journaling is your private coach. It is the mirror that tells the truth when memory tries to rewrite history. Record your setup, your reason, your plan, your risk line, and your emotional state before and after. After the trade ends, record the outcome and the lesson. Most important, score your process. Did you follow your entry rules? Did you honor your stop? Did you sell according to plan? Over time, your journal will reveal patterns you cannot see in the moment. Maybe you press too hard after a big win. Maybe you break rules late in the day. Maybe you chase extended moves when you feel left out. The journal turns vague feelings into visible facts and gives you a plan for changing behavior. Integration is where knowledge becomes reflex. Choose one non-negotiable habit and build a daily routine around it. Maybe it is placing and honoring every stop without exception. Maybe it is writing your pre-market plan before you check any social feed. Keep it simple and track it. The goal is not to do more. The goal is to do less, better, and the same way every time. Simplicity scales. As your consistency grows, your results compound. Not because of a secret indicator, but because you remove the unforced errors that were leaking capital and energy. This is how a trader becomes dependable. Invisible enemies will keep showing up wearing new masks. Pride wants to be right. Revenge trading wants to get even with the market. Overconfidence blooms after a win and whispers that rules are optional. Paralysis by analysis keeps you glued to research while opportunity walks by. Anchoring to the past makes you defend a wrong price because it once felt right. These are not logic problems, they are comfort problems. Your brain is trying to avoid discomfort. Name the trap when it appears. Write the countermove in your plan. If pride flares, say out loud that rules before ego is the standard. If the urge to get even appears, step away and review your journal. If overconfidence whispers, cut size in half for the next entry. If paralysis sets in, take one tiny action that honors your plan. If anchoring hurts your decisions, hide the old price from your screen. The point is not to be emotionless. The point is to have a plan for feelings before they arrive. Every trader evolves if they keep showing up with humility. At first, you are a learner, taking in ideas and testing them. Then you become an executor, someone who follows a plan even when it is boring. With enough repetitions, you become a creator, able to adapt rules to your strengths and to the current market climate. Eventually, you lead others by example, not with predictions, but with process. You prove that self-control beats talent when money is on the line. This evolution is not a straight line. It is a spiral in which the same lessons return at higher levels of difficulty. Your job is to keep your identity steady while the market storms move past. There is a powerful exercise that sets the compass. Write a short letter from your future self to the person listening today. In that letter, your future self explains how peace and clarity came when you stopped trying to outthink the market and started to out-discipline your former self. It says that money followed consistency. It says that you experienced more control over your impulses and that your evenings felt lighter because you were not trapped in regret. It describes how you practiced rules before asking for rewards, and how the scoreboard began to reflect your new identity. The letter is not magic. It is practice for your mind. You are rehearsing the person you intend to become. Let us anchor the practical pieces so you can act today. First, screen for strength using the CanSlim checklist. Look for companies with strong recent earnings growth, multi-year acceleration, something new that drives demand, favorable supply and demand, sector leadership, real sponsorship by institutions, and a market trend that supports the move. Second, decide your entry and exit template before the session. Define the price that qualifies as a valid buy and define the risk line around 7 to 8% lower. Third, write a selling plan that includes quick profits for standard names and trailing rules for potential leaders. Fourth, write a position sizing rule that caps risk per trade and limits the number of positions based on market health. Fifth, write your journal questions for the end of day so your review is not optional. You might ask whether simple rules can really outperform complex analysis. Consider how airline pilots handle stress. They use checklists. In the air, they do not debate trivia while an engine alerts. They follow the checklist. In trading, your feelings are the false alarms and your rules are the checklist. In the heat of the moment, you will not rise to the level of your talent. You will fall to the level of your training. Train the behaviors you want to execute when it matters. Place stops the moment you enter. Buy only when the market confirms with power and volume. Sell into strength when names become extended. Step aside when the indexes distribute. These are not heroic acts, they are rehearsed moves. Another question you may have is how to hold a leader without giving back gains. The answer is to define trailing rules that are mechanical. Decide to sell a portion at a quick 20 to 25% gain to lock progress, then trail the rest using price and volume behavior. If a stock advances and forms tight areas of consolidation on lighter volume while the market remains constructive, you hold. If distribution days cluster and your leader breaks support on heavy trade, you exit the remainder without emotion. If the stock rebuilds a base with proper action, you can re-enter. The rule is to protect progress while giving true leaders room to work. What about missing entries because you overthink the perfect price? Perfection is a trap. Replace the desire to nail the bottom with a plan to buy strength as it confirms. Focus on valid breakouts and on constructive pullbacks within an uptrend. Use alerts and predefined levels. If a stock runs without you, let it go. There will be another opportunity. The market does not pay for hindsight. It pays for repeatable behaviors. Your job is not to capture every move. Your job is to capture the moves your system was designed to catch and to survive the moves you were never meant to catch. You might wonder whether you can adapt this approach to different account sizes. Yes, the principles scale because they are based on percentages and on behavior. A small account benefits even more from strict risk because recovery from a large drawdown takes precious time. A larger account benefits from concentration only in the strongest names and from the clarity that comes with a finite number of positions. In both cases, you are solving the same equation. Protect capital, press strength, and keep your average loss small. Once you internalize that math, you stop swinging for home runs and you start stacking base hits that add up.
There is also the question of how to stay patient between trades. Boredom is a cost of professionalism. You do not have to trade every day. You have to trade well when your signals line up. Build a watch list, maintain alerts, and spend the quiet days refining rules and reviewing your journal. The moment you start trading to feel alive is the moment you transfer power back to the market. Choose purpose over impulse. Keep your energy for the days when conditions give you an edge. Accept that a flat day can be a win because it keeps you fresh for the right day. Let us walk through a case study. Imagine an engineer who is brilliant with systems but often late on exits. After embracing rules, he writes a pre-market plan that includes his entry criteria, his 7 to 8% stop, and his profit-taking plan. On a valid breakout in a strong market, he buys a defined position. The trade moves in his favor. He takes a portion at 20% to book progress, and he trails the rest with his rules. When distribution appears, he exits without drama. He journals the emotions that tried to pull him off plan. The next week, he repeats the routine. His identity shifts from thinker to performer. Now imagine a medical professional who is used to being right. She holds losers and sells winners too early. She implements a single non-negotiable habit. Every trade will have a stop at entry and it will be honored. The first week she cuts 2 small losses and feels the old discomfort rise. She breathes, logs the feelings, and keeps going. By the 3rd week, she notices fewer giant drawdowns and more energy to evaluate new setups. Her account grows slower but steadier. Her evenings feel calm. This is the reward for rules before ego. Consider a teacher who over-researches. He used to spend hours reading forums and watching videos until the opening bell. Then he would freeze. He replaces research sprawl with a 45-minute routine. He screens for leaders, updates the watch list, writes if-then rules, and steps away until alerts trigger. His entries become less random because his mind is not flooded with conflicting voices. He becomes a performer of a plan rather than a collector of opinions. He begins to respect boredom as part of the job. These examples are composites, not real people. They demonstrate that the obstacle was never a lack of intellect. It was a lack of structure around emotions. The CAN-SLIM filter focuses attention on quality. The 7 to 8% stop acts as a shield. The position sizing math keeps risk honest. The journal reveals reality. The identity upgrade makes all of it stick when pressure rises. The framework is simple. The courage to live it comes from practice. Practice is not glamorous. Practice is the reason you can stay calm when others panic. As you internalize this, keep repeating a few mantras in plain language. Rules before ego. Plan the exit. Cut fast and move on. 20 clean trades. Identity over impulse. I execute my edge. Say them out loud and write them in your plan. What you repeat, you remember. What you remember, you rehearse. What you rehearse, you perform. Keep the statements short and actionable so they cut through noise during stress. You can place a small card with these lines near your monitor so that your eyes meet them during the hard seconds. You may still worry that the market will find a way to surprise you. It will. That is why this framework does not ask for prediction. It asks for preparation. When you are prepared, surprises do not knock you off your center. They trigger a behavior you already decided. If your stop is hit, you exit. If the market starts a new uptrend after a follow-through day, you increase exposure with measured steps. If volatility rises and distribution clusters, you step back and protect capital. Your power comes from making rules in the calm and following them in the storm. Let us close by aligning your first steps. Today, build your watch list with candidates that meet the CAN-SLIM traits. Choose one non-negotiable habit to practice for the next 20 trades. Write a pre-market plan for tomorrow with clear if-then statements and with exact risk lines. Commit to a journal entry after each trade that scores process. Place stops at entry and honor them. Take profits according to plan. Review weekly and adjust behaviors, not predictions. This is how you become the trader whose identity is consistent no matter how loud the tape becomes. This video is educational only and is not financial advice. Markets carry risk. Past performance does not guarantee future results. The path described here is not a shortcut. It is a craft. Build it step by step. When you train your mind with the same seriousness that you bring to your research, the market stops humiliating pride and starts rewarding consistency. Smart is useful. Disciplined is profitable. Choose the game that pays you to show up the same way every time. Mind Over Markets will be here to practice with you.